Welcome back to Investing Talk Podcast.
Today we're looking at FIGR Technology Solutions.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. And we have to start with the earnings report. The recent Q3 2025 results. I mean, they weren't just a win.
Not at all. It felt like it set a completely new baseline for how to value this company.
Exactly.
Yeah.
This is the core of the bullish argument. So we really need to understand why it was so explosive.
Right.
It really comes down to this massive acceleration and a real convergence of efficiency. So FIGR Technology Solutions reported $156.37 million in revenue.
And analysts were way off on that. The consensus was somewhere around 119 million, right?
119, yeah, so hitting 156.
Yeah.
That's not just a rounding error. That's a $37 million beat on the top line.
Which translates to a 55% year-over-year revenue jump?
55%. That's a huge number for any fintech company. But what really, got the market's attention wasn't just the sales.
It was what they kept, the profit.
Yes, the net income surge was, well, you called it, monumental.
It really was.
That's the metric that changes the story from just growth to profitable scaling. Net income shot up 227% year over year, hit $90 million for the quarter.
And what that tells the big institutional investors is that the business model has incredible leverage.
Right. The platform isn't just churning volume. It's turning that volume into pure profit at an incredibly high rate.
Which, of course, brings up the whole efficiency question. For a company that's so deep in blockchain tech, the upfront costs must have been huge. A 227% net income jump. That suggests those investments are really, really paying off now.
They absolutely are. And the single best metric to see that is the adjusted EBITDA margin.
Okay.
It came in at an impressive 55%. Think about what that number means in the lending space.
Yeah.
It's huge.
A margin that high basically proves the scalability. They've built something that can handle high volume at a low cost, which is the dream, right? Bypassing all that old school banking baggage.
Exactly. The blockchain system is it's optimizing away entire layers of friction that traditional lenders are stuck with.
So that margin is the proof. The tech isn't just a buzzword. But where's the growth actually coming from? What parts of the platform are on fire?
It's pretty broad, which is a good sign.
Yeah.
The whole ecosystem is getting traction. Consumer loans on their platform, for example, grew 70% year over year.
70%.
Reaching $2.5 billion.
Yeah.
And then you look at FIGR Connect, which is their marketplace.
Mm-hmm.
Volume there shot up to $1.1 billion.
So you have both sides growing, the loan origination and the marketplace activity. It's building its own little financial network.
It's becoming self-sustaining.
Okay, so the company is firing on all cylinders, revenue's exploding, net income even more so, and the margins are incredible. How's the street reacting? Are analysts just catching up?
Well, the consensus is still very positive, which suggests there's more room to run. Right now, you've got 9 analysts rating the stock a buy.
And the price target?
The consensus 12-month target is at $48.83. From where we are now, that still implies about a 21.3% upside.
So even after that huge post-earnings pop, the pros think there's still 20% more to go. That tells me they see this as a real shift, not just a one-off good quarter.
I think so too. But to justify that kind of target, you need more than a good quarter. You need a moat, a real competitive edge.
And that's all about their tech.
It's entirely built on their proprietary technology and, that first mover advantage they have. They are seen as a leader in this very specific niche, a blockchain native capital marketplace.
Okay, let's break that down. Tokenized consumer lending. It sounds a bit abstract. What does tokenization actually let them do that a normal bank can't?
It's all about speed and friction.
Mm-hmm.
When you tokenize an asset like a loan, you're just converting it into a digital token on a blockchain. This means ownership can be transferred instantly, transparently, without all the slow, expensive middlemen. The custodians, the clearinghouses, the weeks of paperwork, it all just vanishes.
And FIGR system was built for this from the ground up. The assets are born digital.
Exactly. So they can process things at a speed and a cost that legacy systems just physically cannot match.
And we have hard numbers on that. This is where the moat becomes tangible. You had some stats on their lending process that are they're staggering.
They really are. Let's just focus on one product. The home equity line of credit, the HELOC. It's a notoriously complex, paper-heavy product for banks to handle.
Okay, so what's the difference? FIGR versus a traditional bank doing a HELOV.
It's a night and day. The industry average time to get a HELOV funded is about 42 days.
Month and a half?
Right. You're waiting over a month. FIGR Technology Solutions, using their system, has a median funding time of just 10 days.
10 days versus 42. So they're literally 4 times faster than the industry. That speed is an advantage, but I think the cost difference is even more important.
Oh, absolutely. The cost difference explains that 55% EBITDA margin we were talking about. So get this. FIGR's average cost to produce a loan is $730.
Dividend 3.
Okay. The industry average for that same service, $11,230.
Wait, hold on. Let's just sit with that for a second. $730 versus over $11,000. That's not a small improvement. That's a different universe.
It's an order of magnitude difference. And it's possible because the blockchain just eliminates all that extensive manual work. The underwriting, the document handling, the layers of verification, it's automated.
So they're operating at a cost basis that's,
Right,
what, 93% cheaper than the average?
Not about that, yeah.
Which give them 2 options. Either they can undercut everyone on rates and grab huge market share, or
they keep market rates and just enjoy those astronomical margins,
Yeah.
which is clearly what they're doing right now.
Yeah.
This isn't just a moat. It's a genuine threat to the old way of doing things.
Okay, that foundation is incredibly strong. So let's pivot to the technicals. The stock surged 24% after earnings. Is that momentum holding up? What did the charts say?
The charts confirm it. This is a sustained bullish trend. It looks like institutional buying, not just, retail hype. The stock is trading well above its short-term moving averages and, more importantly, the 200-day moving average.
Which is that classic signal for a long-term uptrend being in place.
Exactly.
So for people watching the charts, where are the key levels? Where's the support and where's the resistance?
The main support zone you want to watch is between $35 and $37. That area was resistance before the big earnings gap up, and now it's flipped to a support floor.
So if it pulls back, that's where you'd expect buyers to step in.
Right. And on the upside, the big test is the 52-week high. That's up in the $49 to $50 range. If it can break through 50 with conviction, then a whole new trading range could open up.
What about momentum? A 24% jump can sometimes push things into overbought territory really fast. Are we seeing that?
Not yet. The indicators are strong, but they look healthy. The RSI, the Relative Strength Index, is in the 60 to 70 range. That's strong, but not screaming overbought.
And the MACD.
We've got a confirmed bullish MACD cross, which
Wow.
just reinforces that the underlying trend has positive momentum right now.
So a powerful story backed by strong technicals. Let's look ahead. What are the catalysts we should be watching for over the next, say, 3 to 4 months?
Well, the big one, the confirmed one, is the Q4 earnings report. That'll be around February 2026. The market is going to expect continued strength after Q3.
Another beat there would really solidify the narrative.
It would. And beyond that, you've got December and January. Those are big months for institutional moves.
You mean like index rebalancing?
It's exactly. Index and ETF rebalancing. If FIGR gets added to new indexes, or its weighting goes up, that forces funds to buy the stock. It creates a nice, steady source of demand. Plus, in January, we'll get the big institutional holdings disclosures. We'll see which big funds are placing their bets.
Okay, so those are the knowns. What about the unknowns? What are the rumors, the unconfirmed chatter that could really move the needle? And we have to stress, this is just speculation.
Right, strictly unconfirmed. But the biggest buzz is around a potential strategic partnership. There's a lot of talk about a deep integration with a large national bank, maybe for Q1 2026.
Wow, that would be huge. If a major bank basically validates their tech by using it themselves.
It completely de-risks the platform. It moves them from being just a disruptor to being a core infrastructure provider.
What else?
There's also chatter about a new digital asset-backed lending product. And of course, M&A talk. Either FIGR buying smaller players or a giant buying FIGR to get their tech.
Any of those would be explosive. But let's zoom out. For the long-term investor, what's the big picture tailwind here?
It's the whole global trend towards tokenization of everything. We're in the very early innings of a fundamental shift in how financial assets are created and traded. FIGR is right at the center of that. That gives them a multi-year runway for growth.
It sounds almost too good to be true. Fantastic numbers, great chart, huge tailwinds. So we have to talk about the risks. What could go wrong here?
The biggest one, for the whole sector really, is regulatory uncertainty. Digital assets are still a bit of a wild west. An unexpected, unfavorable rule from regulators could create major headwinds.
That's a sector-wide risk. What about risks specific to FIGR?
Okay, a couple things. First, they still have a lot of their revenue concentrated in HELOCs. If the housing market takes a sharp downturn, that could hurt them. And second, this is important that they have previously disclosed material weaknesses in their internal controls.
A material weakness. That sounds serious for a financial company. What does that mean exactly?
It means the company itself admitted its internal processes for financial reporting weren't perfect. Now, the good news is management is actively working on it. But it suggests that maybe their growth, their operational scaling, got a little ahead of their back office compliance stuff. It's something you have to watch.
And I guess the final risk is just the macro environment. At the end of the day, they're in the lending business.
Correct. A recession, a spike in unemployment that affects the credit quality of their loans. Their tech makes origination cheap, but it doesn't make the loans themselves recession-proof.
Okay, so let's tie this all together. The massive beat, the 55% margin, the strong chart, the catalysts, but balanced against these very real regulatory and internal risks. What's the final synthesis?
I mean, the thesis is still highly bullish. I'd score the outlook a 9 out of 10. This is a true disruptor with accelerating earnings and a clear leadership position.
And who is this for? Short-term trader or long-term investor?
I think it works for both, which is rare. A momentum trader can play the technicals and the partnership rumors, but a long-term investor should be focused on that massive structural shift to tokenization.
Which brings us back to those numbers. A process that's 4 times faster, 10 days, versus 42 and over 90% cheaper. If they can maintain that fundamental advantage and then scale it, you really have to ask yourself, what does that imply for the survival of traditional banking models that literally depend on that old, slow, expensive friction? That's the real question this company poses to the entire industry.